The more trades you take will expose your trading account to more risk. This video is part of our Intro to Risk Management series. You can check out our full series on our YouTube playlist. Some key principles in performing effective risk management is that you can adopt position sizing as well as account management. Position sizing is more about each individual trade, how you should be sizing each individual trade, how much lot size you should be trading. That's position sizing. Account management deals with a larger scale, a more macro scale, a more overview. We should be covering both. All right, let's start with position sizing. So here, what we want to be looking at is that how much should we be trading on each individual trade? One of the key things is that you should always be thinking in terms of relative percentages rather than absolute dollar. What I mean is that, given an example, I will use an analogy. I funded my account for $1,000. And I set a rule for myself is that on every trade I take, I want to be risking 1% of my account. On a capital of 1,000, that will work out to be $10. So I started trading, and once again, in the risk management approach is that we take worst case scenarios. So because of market unfavorable conditions or market volatility or whatever it may be, I lost half of my account. I'm only left with $500. If I'm still thinking in the sense of absolute dollar, what will happen is that I will still continue to use 1% based on 1,000, which is $10, right? So $10 in the face of my new current balance, which is 500 because I lost half of it earlier, is actually more than what I'm willing to risk, because I remember that I'm only willing to risk 1%. So $10 in the face of 500, which is my new capital, is actually 2%, which is essentially double of what I'm willing to risk. This shows the importance of why is it important to always think in relative terms of percentages, right? So given $500, what should happen is that if I'm still willing to take on 1% on each trade, I should be doing 1% on a balance of $500, which will work out to be $5 instead of utilizing the full $10. Some factors to influence your position sizing, of course, is your account sizing, leverage requirements, so your leverage settings, your account size, how much are you willing to fund your account, as well as your risk tolerance. So your account size, which is your account funding, or rather your account balance, and your risk tolerance, these two things should be determined by you, should be determined by each individual traders for your own consideration. These things can change over time, but ideally you should figure out this yourself. So risk tolerance, initially newer traders can maybe prefer to adopt a lower position, like let's say for example 0.5%, some would like to go for 1%. But you should figure this out yourself. Test your strategy, find out what's your threshold that you're comfortable with. At the end of the day, it's about your comfort level, because this is your money, you should have full control of it. Comes next is your strategy, trade frequency, as well as the length of your trade. How your strategy functions. Okay, in most cases, a more common scenario is, let's say for example, your strategy trades on a larger time frame, like maybe daily or even weekly charts. What will happen is that chances are that you are going to hold your trades for a longer period of time, which brings about the question on how many trades will you be taking on a single time. All this will influence how you should be trading, your position sizing, your lot size. These factors will come into play. Next comes consistency. Okay, consistency is very, very important. Okay, what you want to be adopting is a consistent approach for risk management. What it means is that, for example, initially I would like to trade 1% on each individual trade. When I do a 1% trade, my next trade shouldn't go 3%. On every individual trade, I should not be varying the risk allocation too much. If I decided to be 1% on each individual trade, I should take on an approach on each individual trade should be roughly around 1%, maybe plus minus 0.1, 0.2. depending on certain conditions as well. For more experienced traders, of course, there will be an approach whereby you vary your risk allocation dependent on certain factors such as strength of setup, right? Whether it's a favorable condition or favorable risk-reward ratio, we will vary for that. But for beginners, a general good rule of thumb is that you want to keep it consistent. If, let's say, a rule or threshold that you set for yourself is 1%, you want to keep it within the range. Next comes account management. So position sizing is about how you manage your risk allocation on each individual trade. Account management does it as a whole. Your entire trading account as a whole. So early on, I mentioned that how many trades will you be taking on a single time? This will come about to be your total exposure. What this means is that at any point in time, how many trades will you be taking on? Like, let's say, for example, I am going to be trading 1% on each trade, and I kept that rule going for all my trades, that I've taken on 20 trades, meaning to say I've taken on 21% trades. On the worst case scenario, what might happen in a huge market swing is that I might lose 20%. Alright, I might go into a 20% drawdown. This is essentially your total exposure. You have to understand that the more trades you take will expose your trading account to more risk. So set a threshold for yourself. Like, let's say, for example, I am willing to take maybe on each individual trade for position sizing, I'm willing to allocate maybe 1% risk. But on an account as a whole, I'm willing to take up to maybe a threshold of maybe 10%. What this means is that if I trade 1% on each individual trade, I can take 10 trades. Alright? However, if I scale down each of my individual trade, I'm willing to do 0.5%, I can do up to 20 trades. That would still be within my total exposure or what I'm comfortable with of 10%. Next, set a maximum loss threshold for yourself. What is your loss limit? Okay, what you are comfortable with. Okay, so because markets can be unpredictable, a major swing in the market could set you back for all the positions. Okay, in the worst case scenario, all the open positions that you have taken. So if that happens, right, what you can do, okay, one of the methods that can be adopted is that you can go back to the drawing board, re-strategize, figure out whether is it outlier condition, whether is it simply a bad market condition, or maybe you want to reevaluate your trading strategy, your trading plan. But in the meantime of doing so, you want to maybe lower your position sizing. In more extreme cases, you can maybe take a break from the market, reevaluate, re-strategize your strategy, and then when you are more comfortable, okay, you can start trading again. That's all for this video. Thank you for watching. You can check out the rest of our playlists on our YouTube Intro to Risk Management playlist. If you want to learn more about trading fast, trading smart, head to MyTrade Academy, where we'll deep dive into the world of trading.